All right, donated property. Now, you might be saying, all right, who's going to donate property to a corporation? It's kind of funny because you will see questions on the exam talking about donating property to a corporation. I don't know why I would donate property to a for-profit entity, but hey, we have questions on them, so that's what we're going to deal with. Now here, let's talk about what happens if we donate property. This example illustrates how to calculate a taxpayer's basis in property donated to them. So this is not dealing with the corporation. I was just bringing that up because I thought about it, thought it's kind of funny. We'll consider two key factors. We've got the donor's adjusted basis in the property and the property's fair market value at the time of the donation. Now, let's say person A, who is the donor, wants to donate a piece of land to person B, the donee. So person B is going through a rough time. You want to help them out, give them something, kind of like gifting as well. So donor's adjusted basis. Person A originally purchased the land for $50,000 and made $10,000 worth of improvements. Their adjusted basis in the land is going to be that $60,000, which is the original cost of $50, plus improvements of $10. The fair market value that's going to be given to you, that is $80,000. This is the information that was given. What's the prompt? We got to calculate person B's basis in the donated property and determine whether the property has appreciated or depreciated in value since person A acquired it. Well, shocker, it looks like it has appreciated. Now, in this case, the property has appreciated because the fair market value is $80,000. That's greater than the donor's adjusted basis of $60,000. Now, when a donee receives appreciated property, their basis depends on whether they will use the property for personal use or sell it. Now, these are some rules. These are some new rules being introduced. I like to introduce rules through examples because it's a great way to see how it actually works as compared to me just kind of talking about the rules and not really applying them. Now, situation A, if the person B wants to use the property for personal use, their basis in the donated property will be the adjusted basis, which was 60. If person B plans to sell the property, they may be subject to gift tax rules, which we'll talk about in that lesson. And their basis for determining gain would be the donor's adjusted basis, $60,000, while their basis for determining loss would be the property's fair market value at the time of donation. Now, if person B sells the property for a price between the adjusted basis and the fair market value, they would not recognize any gain or loss. Again, this sounds quite similar to what we saw earlier with gift, all of that, gift tax, basis in gifted property. Now, to sum this all up, in this example of a property with appreciated value, person B's basis in the donated property would be $60,000 for personal use, or for determining gain when sold, it would be $80,000 for determining loss when sold. So this is something that also does have the same roots in the rules we saw earlier. Make sure you're revisiting these examples as needed, comparing them, seeing the differences, seeing the similarities, and you'll be good to go. All right, nice little recap here on basis and holding period of assets. For the basis, that is going to be the cost of the asset plus any capital improvements. This is going to include all of the costs that were needed to put the asset into service. It's going to be reduced by accumulated depreciation. Now, the holding period begins on the purchase date, not the date it was placed into service. That deals with depreciation. The basis of an asset generally refers to its cost or value for tax purposes. The IRC provides rules for determining the basis of assets, which can affect the amount of gain or loss that's recognized when the asset's sold or otherwise disposed of. We've beaten that to death for sure, but now you know what the whole purpose of this lesson was. The holding period of an asset refers to the length of time that the asset is owned by the taxpayer, and the holding period can also affect the amount of gain or loss that's recognized upon the sale or disposition of the asset. Another wonderful lesson down in the books. Make sure you are revisiting as needed, practicing those sims, those multiple choice questions. You got this. You can do it. It's going to take a lot of work, but if anyone can do it, you can do it. Let's wrap it up with a nice summary and call it a day. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.Examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit CPA.Examprep.ai and let's achieve your exam success together.